Hey,
Good. How are you?
I'm good, thank you.
So what can I do for you today?
So we're going to talk about the mortgage process and how to get pre-approved, um, the different types of mortgage programs, and the qualifications for them, and what they need to in order to qualify for it.
Okay.
So why don't you start by introducing yourself?
All right. Thank you. I'm Perry Farella from Prime Lending here in Chicago. I have been a mortgage banker and loan officer now for 19 years locally in the Chicago area. I have experience both with first-time buyers, investors, multi-unit properties, and I also do a lot of renovation lending where borrowers can borrow the dollars they need to upgrade or remodel or fix a home in the same 30-year mortgage. The key to a mortgage approval and getting pre-approved is really two things: credit history, credit score, and then income and assets. And it's always a balance of those two things.
Right.
So what we do initially when we first contact a borrower is we ask what the credit scores are and what the credit history is. If the borrower doesn't know that, then we'll pull the credit reports for the borrower, and we'll coach or help the borrower if there's anything in the credit history that's detrimental to getting a mortgage approval. Maybe a lower credit score than normal. So we often do what we call rapid rescores from that point, where we'll take a credit report, we'll go to the credit reporting agency that aggregates the data from the credit bureaus, and then we'll say, well, if we want to get the score from here to here, what does the borrower have to pay down? And many times it's just paying down the balance on a credit card to a lower utilization. Mm-hmm. Credit scores are driven by credit card utilization. So if you have a credit card and you have a maximum balance and you're always at that maximum balance, then that drives 100% utilization, but that drives down your credit scores. So we work with credit scores too and help borrowers get that element set up as part of a pre-approval.
Got it. So right now, what is the credit score qualification to be approved for a mortgage?
Currently, both FHA and conventional would be at a middle credit score of 620 to get a typical rate. We can do FHA loans down to a score of 580.
Wow.
Depending on why the score got to 580. Sometimes it got to 580 because of other detrimental things that would cause roadblocks.
Right.
To get first. But generally speaking, if someone has a middle score out of the three scores we all have of 620, then that sets them up for either a conventional loan or certainly an FHA loan or a VA loan.
So what is the difference between and of course you and I know this answer, but for my listeners who don't know this, what's the difference between well, I know you can explain what a VA loan is, I know that's separate, but a conventional loan and FHA program, as well as the VA. You want to add that in there?
Sure, we can add it in too. An FHA loan has the lowest potential down payment of any of the loan types other than a VA loan, which is always 100% financing. But an FHA loan, you can buy a 1, 2, 3, or 4 unit property with only 3.5% down, regardless of the property type, as long as it's owner occupied. And a little known fact on FHA loans is that they're assumable to the next buyer. You could actually transfer the mortgage to the next buyer if it was at an attractive rate in the future when the property is sold.
Okay.
VA loan also works that way for veterans. And another attractive option on FHA is that, particularly on the multi-unit properties, the borrowers need only live there for the first 12 months. Then they can move out and convert the multi-unit into all tenant occupied and still keep that VA loan.
Wow.
The only quantifier on that, though, is that a borrower can only have one VA loan open at once because they were meant to be owner-occupied loans. So I have some clients that sometimes will buy a 2, 3, or 4 unit property on a VA loan because the down payment's only 3.5%. And the rents are so high usually, and interest rates are so low, the numbers usually work out. But then after a year, they may want to move on and buy another multi-unit or buy their own single family. So sometimes what we do then is If they don't want another FHA loan, we leave it in place. But if they want to do a second FHA loan, we have to refinance out of the first one back to conventional.
Okay. So let's say the buyer is interested in doing an FHA loan and they want to do a multi-unit building, like a two flat building per se, let's say. And I know that there's a difference between what happens with the 2-unit versus a 3-unit. But let's just keep it simple. We'll start with the 2-unit first. So when they're purchasing a 2-unit, explain how the rent from one of the units can be added into their income to get qualified.
Yes, on a 2-unit property, on an FHA loan, or actually even on a conventional loan, borrowers would have the rent coming in from the second apartment. They would live in the first one. So we were able to take the rent at 75% of gross on the second apartment and give that to the borrowers as extra monthly income to qualify for the size loan they need. And this could be true even if the building was vacant and there are no tenants and there are no leases to look at. We depend upon the appraisers to do a future rent assessment. And they do an area rent survey, and they'll come back with what the rent should be, even on a vacant unit or a vacant building. And then we'll still give the borrowers 75% credit for that future rent that we know that building will command. And that helps borrowers that otherwise might not be able to have the larger 2-unit mortgage be qualified for it just because of that.
Right. And so then the 3-unit and more, it's a little trickier, even though you can still use a FHA program, but it's a little more trickier in terms of what you'll have to have in cash available.
Yeah, the 3 and 4 units have a couple more regulations in FHA lending. One of them is that they have to have at least 3 months of mortgage payment money still left over in reserve after they pay all their closing costs and down payment. That's called reserves. And then the second special requirement is something called the self-sustaining test, meaning that a 3 or a 4-unit property, when we count the rents from all 4 units, even the one the borrower would occupy, at 75% of gross, all 4 of those rents at 75% of the gross rent must at least equal what the total house payment's going to be, including property taxes, home insurance, principal and interest, and private mortgage insurance for FHA. That's called self-sustaining test.
All right. So now let's talk about the difference between, because you mentioned PMI. So let's talk about the difference between the FHA and the conventional loan, and then we'll talk about 203K after.
Okay. On an FHA loan of any kind, we know that the down payment only needs to be 3.5%. It can be larger, but that's an attractive feature of any FHA loan, particularly for 2, 3, and 4 units. Everyone can come in with only 3.5% down. The FHA has its own version of private mortgage insurance, and it's at a flat rate, meaning that everyone, regardless of credit score, regardless of down payment, pays that same flat rate every month with their payment for all 30 years of the loan. And that flat rate is a factor called the private mortgage insurance factor, which is set at 0.0085 times the loan amount divided by 12, gives you that monthly FHA mortgage insurance that you pay all the time with your payment. FHA has a second mortgage insurance charge that's paid at the closing table on closing day, and that's called the upfront premium. And that's 1.75% of whatever the loan amount ends up to be.
Right.
And that's the fee that funds the program. But that fee is not really paid in cash most times. It's actually added to the loan size and financed into the loan so that borrowers aren't really paying all of that at closing, which would make the loan probably even unaffordable for them.
Right.
So it's financed into the loan all the time. The 0.0085 factor is their monthly mortgage insurance cost for everybody, regardless of credit score or down payment. There is some talk this year that FHA might review that and drop that cost a little bit to make the monthly payments more affordable. There's also some talk that they may no longer require that to be paid for all 30 years of the loan.
I see.
So we'll have to see how the year unfolds to see if HUD changes those requirements.
Okay.
Then to answer on the conventional side, private mortgage insurance is furnished by various companies that sell that, and they have specific rates that are tied to the type of property, the size of down payment, and the borrower's credit score.
Okay.
So those factors can vary widely. That's why many times it's often more economical in terms of the monthly payment to have a borrower use the FHA version, even with a 20% down payment, because if they have maybe a lower credit score, their monthly private mortgage insurance will be higher than what FHA would have charged.
I see.
But sometimes FHA is a benefit just for that reason alone.
Yeah, because some people think that conventional is, although it's more expensive up front, it's cheaper in the long run. And then FHA is cheaper up front, but more expensive in the long run.
Yeah, that is potentially true. On the conventional side with mortgage insurance, there isn't any upfront fee that's paid at closing.
Mm-hmm.
It's all either monthly, or with conventional private mortgage insurance, they do give the option, if you want to pay it in one large sum at closing. Okay. And never pay anything monthly.
Oh, okay.
That's called single premium private mortgage insurance. Okay. And sometimes it makes sense to do that if a borrower is going to be in that same property for at least 5 years, and it'll be paid for in 5 years, and they will have made an advantage over doing the single premium version than spreading it out monthly, because the private mortgage insurance companies will require any borrower to pay that private monthly mortgage insurance for at least 5 years, regardless of how high the value of the property goes or how much they paid on their mortgage.
Right.
So there are some nuances on mortgage insurance on either side that are specific to everybody's case.
I see. So 203K, which you are very known for doing. I don't care what you say. Everybody in the industry loves you and know that you can get the job done when it comes to 203Ks. So let's talk about that. This is a special type of lending all by itself. The ins and outs of how that work. Just from, we can break it into chunks, because I know there's an element of the HUD consultant that has to come into place. So we'll talk about that, after in the second half of it. So go on, explain to us what 203K means and how it works.
Sure. 203K is a section of HUD financing of FHA loans that allows the borrower to add into the same 30-year loan at the same 30-year interest rate enough funds to update, modernize, repair, even rebuild a 1, 2, or 3, 4, or 4 unit property, as long as it's owner occupied, like all FHA loans. So I have a lot of clients, for example, that will look at a 2, 3, or 4 unit property that needs to be updated, or it might even be an estate sale or foreclosure where not everything is working, where nobody has touched anything in decades. So they would add on the extra funds to that same loan. So for example, if they buy a property that costs $100,000 and it needs $100,000 of renovation, to us, that's $200,000. Then their 3.5% down payment is off that $200,000, which would be $7,000. And then the rest pays for the entire purchase of the property and that $100,000 renovation, all in that same 30-year loan at today's low rates. And then the borrower would realize the benefit of living in perhaps a brand new property, essentially, that's been gut rehabbed, and realizing the higher rents that could come from having a brand new property.
Exactly.
Many borrowers add a laundry in every unit, for example. They add an HVAC system, so each tenant controls their heat and air conditioning, which commands larger rents, dishwashers in the kitchens, maybe even adding a second bathroom. So all of those things are possible with 203K on a very large scale, or even on a smaller scale. I've had borrowers that will buy an old single family house that no one has updated in the last 40 or 50 years. And they just want to borrow enough extra money for a nice renovated kitchen and maybe a renovated bathroom and maybe to finish the hardwood floors.
Right.
And maybe they can do all that on $30,000 or $40,000. And that's all they really want. And the key to making those loans work and the benefit to all the borrowers is what's called after renovated value. meaning that on a 203K loan, we are more concerned about the after renovated value after it's finished than what they pay for it today.
Right.
Meaning that we give them the benefit of the future equity right now as if it was still there. We just ask the appraiser to appraise the property to its after renovated value based upon seeing the dollar amount and the type of work that's going to be done after closing in the property. All of this is done after closing. We don't care how trash the house is. It could be flooded, there could be no heat, no plumbing turned on. None of that matters anymore with the 203K loan, because all of that will be fixed after closing, and we will know what the after renovated value is by the appraiser doing that after renovated value appraisal. And that's how those loan approvals work. And that's why it's such a benefit for a borrower, because maybe the borrower got a really, really good deal because the house was so scary and so trash, and no one else wanted it. So they bought it at a depressed price.
Right.
And then they put their money into it. Not only did they get back every dollar they put into it, but they got back a lot more.
Exactly.
And that's why you would do this. It's called hidden equity, or realizing the hidden equity or the future value. And that's where we come in, because we analyze all those numbers at the front end to make sure all this is going to work. So the borrowers can't really make a mistake on a 203K. It is designed for people who have never done renovation before and maybe never will. And that's okay, because we give them the oversight and the structure to make sure they don't make a mistake by projecting the after renovated value at the beginning, by making sure that the contractor has been validated and it is not a contractor that has been in trouble in the past, let's say. So we do all of that for the borrower. Then we bring in what's called a HUD 203K consultant. And that is a person who is an expert in construction, often either a contractor or also a licensed home inspector. They're also HUD construction consultants. And they do a more detailed inspection of the property from a construction perspective. And they determine what needs to be done per city codes or local codes, what HUD would need in terms of making a house minimal, in terms of minimal property standards, like no peeling paint, no holes in the roof, that kind of obvious things. And they take into account the input from the borrower. And then they do a financial projection for the borrower too, so the borrower has an idea of what a contractor should be charging. And that document we can share with the contractor without the numbers on it. It just has all the work or the tasks. So then the borrower can easily shop for a contractor and have them fill in their numbers. And then the HUD consultant will review it, make sure it's not too low, and that it's realistic for what can be done. And as long as it fits into the after renovated value, then that's how we approve these loans. And that's what makes them such a huge advantage.
Yeah, I mean, the beauty about that program is, and I want people to understand, is if you purchase a property in an area when the house is undervalued, and when you do the repairs to it, not only do you get the added bonus of moving into a home that is completely renovated or repaired or whatever to your likings, but you also move into a property that is right side up on your mortgage versus the value of the property. So that is a very good financial tool, especially if you're interested in doing, when you refinance your home, you can do other things with the equity in the home. So I think that is a great program. So moving along, let's talk about how is your credit, your income determine like the amount you can actually afford?
Yes, I mean, it's a really good question. So what most lenders will do is we will use what we call the 45% rule, meaning that we would take someone's gross monthly income before any taxes, before any deductions, before any healthcare costs are deducted, before 401k deductions, anything like that, whatever the gross monthly employment is, and we would take 45% of that. And of that 45%, that's how much a borrower would have to fund all of their monthly obligations, which could include some student loans, minimum credit card payments, car note payments, for example. And whatever is left over out of that 45%, that is what they can use for the housing payment. So that's how we often work backwards.
So another thing, I'm sure people hear this a lot, is deals die at closing. So
We
let's,
don't want that.
but that happens. So as a buyer, what is your responsibility to make sure that you're able to close on your end on closing day?
Really two things. As a buyer, be mindful of not getting any additional credit extended to you during a loan approval process.
Mm-hmm.
Meaning don't go out and buy a new car, don't buy any furniture in advance of closing on the house and then put it on your credit cards. Lenders will always monitor credit usage during a mortgage approval process to make sure that doesn't happen. Don't sign up to buy a second property at the same time with another lender. Those are things that we've sometimes seen. Mm-hmm. So it's watching your credit and putting kind of a hold on getting any new credit during that period. Mm-hmm. And then the second thing is always being mindful of having enough cash and funds on hand to close.
Right.
So the lender will always forecast to you as a borrower or buyer what cash you need on hand to close from the beginning. Mm-hmm. So make sure that you continue to save your money, don't spend your money on something else, put things on hold. And another area that I have seen come back and be a very negative surprise is occasionally a borrower will do a cosign as a favor for a friend or relative for maybe a car or something else. And when you cosign for it,
that's new credit.
You are assuming that responsibility, and then we have to assume that someday you may well have to make that payment. So then that decreases your potential funds of your own to go towards your own mortgage.
Exactly.
So I'm a big advocate for warning people about not co-signing for things, even for your children. If you are in a situation where you think in the next year or so, you may want to buy a property and have a mortgage, don't do any co-signing is really the message.
Okay.
Because that can be lethal and that can kill a deal even before closing, because if it's not detected until later, or if it's done during the mortgage process and it is detected, then that could potentially wipe out the potential for the loan approval.
Yeah, that I've seen some teary eyes close to closing when things like that happen. Not so much as the credit, because I'm an advocate of telling my clients, do not do anything. Do not finance a piece of gum. Like, don't do nothing. So, but I've seen stories, and I've seen my clients. I had one client in particular that got to closing day and didn't have all of the funds to close. We had to extend it back about a week in order for him to get the money. So, so what do you? I got like so many thoughts running through my mind at one time. So, like, is there like a what does your client get in order to know what they need to have up front for cash? Like, is there like a fee statement, or what's the breakdown of what they get to know what they're paying for at closing?
Yeah, what lenders do is we give out what are called lending estimates. And that is a very firm document with the specific purchase price, the down payment, what the cost of the mortgage is going to be, the cost of the property taxes, home insurance, mortgage insurance, and then what the cash needed to close might be all up front. But even earlier than that, what I usually like to do is I like to give clients an example before they even have any properties in mind. So once I know their income situation, what monthly obligations they have, and we've done a pre-approval relative to, let's say, that 45% rule, and we know what they can afford per month, then what we'll do is we do what's called a cash to close worksheet.
Okay.
And that is an early sheet at some given purchase price, at some given property taxes, because every property has a different property tax bill every year. So we might forecast that a client might spend X dollars on property taxes in a given property type in a given location, and with a given down payment, a given interest rate. So we do what are called cash to close worksheets, which also will have a projection on them of what the monthly total mortgage payment is going to be. Because one of the questions I always ask a client is, what are you going to be comfortable with as a housing payment every month? meaning that if I take you to the very max of your 45%, maybe that's a number that's even too high for you, and you don't
Right.
really want to go to the max.
Right.
So one of the things that I always like to ask clients and new buyers, especially first-time buyers, is what are you used to paying for in rent now, and what would you like to go to that's comfortable for you?
Right.
And then you can take that number and work backwards to get to a purchase price with a given down payment, with given property taxes.
Okay.
And then they can be very targeted as to what kinds of properties they're looking at what price points, because that will give them that monthly number, that payment that they're going to be comfortable with.
Mm-hmm.
Even though I might say, oh, you can be approved for 50% more, that's not what everybody wants,
Right.
and that's not in their best interest either. So one of the early questions I always ask is, what is your monthly number that you would be comfortable with your full housing expense? And then we can all kind of work backwards from that. And then occasionally the borrowers will go out and they'll see listings, and that they realize that those listings that fit that number aren't what they want, and then they do go up a little bit. Mm-hmm. But it's always helpful to get the borrower's take on what's going to be comfortable for you.
Right. So my last question, what is your advice to people who are thinking of becoming a homeowner or a property owner in this in this respect? What are some things they can do to get prepared? Is there like some sort of guideline they can come on your website and find, or what do you feel is the best steps to get them going in that direction?
Yeah, what we always want to do is take a look at what the borrower's credit history has been. Mm-hmm. Even if the borrower isn't going to be moving forward for 6 months, I often say, let's take a look at the credit history now. So if there's anything that we need to clean up, or anything that we need to pay down, or see how we can get to a higher credit score. And the reason why credit scores are so important is that credit scores drive the interest rate that people would pay on their mortgage.
Right.
So if I find somebody who's at a 640 today, but I see a path to get them to a 680 in a month or two, then I can give them those instructions, and then you can rescore them once they've done the reductions, let's say in credit card balances, for example. Because the difference between a 640 interest rate and a 680 interest rate, maybe that's a half of a point. Mm-hmm. And to them, maybe that makes the house $50 or $100 less costly every month, just because of the credit score on the same property. Right. So that's why we always like to look at a good 6 months in advance and ask people to begin planning in advance.
Okay.
And then just a word about credit scores. I often get questions about, does my credit score drop if my credit is checked numerous times?
Yes.
And the answer is, it depends, meaning that if you're shopping for a mortgage and your credit score has been checked by 2 or 3 lenders, let's say in the space of 30 days, that should not be dropping your credit score.
Right.
But if at the same time, you're also having your credit checked because you're thinking about getting a new credit card, you're thinking about getting another cell phone, or even potentially a car loan, then we have all these other different varieties of credit being checked. Mm-hmm. That's what will drive down credit scores. So that's why I would ask borrowers to put a hold on any future plans for making changes. Like even if you walk into a store and they give you 10% off today on what you're buying because you opened their store credit card, mm-hmm. that's a credit check. And that's credit that they're giving you, even if it's a small amount, that could be detrimental to your overall credit scores.
Right.
So I always caution borrowers about attempting to have multiple sources for different reasons other than a mortgage lender checking your credit at the same time, because it will drive the scores down.
Right. Not only that, but they also should have a plan for saving as well, so that they're ready with the down payment.
Yeah, because what can happen, if we often structure deals where we can get the seller to pay the closing costs, and
absolutely.
borrowers would know that. So if a borrower is saving and they have about their 3.5% down payment, but they don't have the money for closing costs, borrowers often don't realize that closing costs can be 2, 3, 4% of their purchase price, especially in County or Chicago. So then that's an extra expense that they hadn't forecasted. So what we can do on an FHA loan, particularly, and this is an advantage of FHA, is that any borrower can ask any seller to give them up to 6% of the purchase price back as a credit or as money to pay for any and all closing costs. And that could be the entire first year of the home insurance policy. That's a closing cost. Their attorney fee, putting out some money to fund the mortgage escrow for future property taxes. We could even use some of that money to buy the interest rate lower in the form of prepaid interest.
Yes.
Most people don't need 6% for their closing costs, but usually a good 3% will take care of it in Chicago.
Yeah.
That's why I always caution first-time buyers, go ahead and talk to your agent and structure the deal so that right off you're asking the seller for either a fixed amount, like $3,000, $4,000, $5,000, or a percentage like 3%, but offer aggressively enough on the purchase price that when they give you that money, they'll still be happy with what they're going to get.
Exactly. I always tell my clients that if you're interested in closing costs, then don't try to shortchange them on your asking price. Then, like, give them list price if you're asking for, especially if you're asking for at least 3% of closing costs. You should definitely give them list price on the property. So I'm an advocate for that as well. It's just that I don't like when buyers try to lowball the offer. So.
And then the other thing that we always want to tell buyers is if they are having difficulty saving for a down payment, they can always get a gift from relatives.
Yes.
And that's true of both conventional and FHA loans. The entire down payment on an FHA loan, the whole 3.5%, let's say, can completely be a gift from one or more relatives. I've had borrowers who've gotten money from each parent, each grandparent, brothers, sisters, and that's perfectly fine. And then they can have the seller pay all the closing costs in the contract. So theoretically, a buyer can come in with an FHA loan and really have almost no money of their own because they can have the seller pay the closing costs. They can get gifts of down payment from the parents or relatives or spouses, significant others, etc. And as long as they qualify for that size mortgage they want, that's how you can put a whole deal together. That's really helpful for a first-time buyer.
Yeah, it is. In the perfect world, all of those are some great moving parts that have to come together in order for that to work. So and this is my last question, so we're running over time a little bit. What types of documents do buyers need to present to you to get qualified?
The list of documents we would ask for buyers would be typically the last 2 years of federal tax returns. Because that tells us two things. Do they own any other properties they're paying interest on, which could affect the loan? Are they self-employed, which could also affect the loan? Self-employed borrowers, the calculations are done differently than a borrower who works for a company and gets a W-2.
Okay.
And then I would ask for any W-2s for the last 2 years. I would ask for pay stubs for the last 30 days.
Okay.
A contact to call and verify employment at your company. And then a photo ID, and then the last 2 months of your checking, savings, asset statements, wherever you keep your money. And these days, with everything being done electronically, all that can be uploaded directly to a lender's portal. We give users or clients an opportunity to create their own user ID really in our system. And then they can securely upload these things. They don't have to be emailing. They don't have to do any more faxing. And then the loan application is also done via email these days. We call it e-signing.
Okay.
So virtually everything can be done online other than the actual closing itself.
Okay.
So we try and make it as simple as we can and as painless as we can for borrowers so they can do it from their phone, literally.
Oh, wow.
And so everything is moving so much more rapidly today. And so lenders are also doing that as well to make things much more convenient for borrowers. And I often say, for your photo ID, just take a cell phone picture of it for me.
Yeah.
And I have some borrowers that will take cell phone pictures of all of their documents and transmit it to us that way.
Right.
With borrowers that will text me everything. and that's fine too, because we can then, save it into a file. We'll print it out on paper if we have to.
Right.
So lots of different ways of getting the data quickly and electronically these days from borrowers. Okay. And that, I think, is one of the best advantages over what it was maybe 10 years ago.
Yeah, it is. even early, yeah, definitely, even early 2000s. Well, Mr. Perry, I really appreciate your time and your wealth of knowledge you have shared with my audience. If you can just say the name of your company again, I will link all that information in the description box when it's posted. But just so they know how to reach you.
Yeah, I'll give you my company name, which is Prime Lending, and then I have a couple different websites that I use, but anybody can reach me from either site. And the one site that I use a lot is called howtofundrenovation.com. And from there, you can find my email, my phone number, et cetera. And there's lots of stories of what people have done with renovation loans there. If you want to read more generally about loans, then that would be my personal website, which is perryfarella.com. You can Google me and you can find me online, in many different ways. And I'm always happy to talk to anyone, evenings, weekends. It's a 24-hour world these days.
You got to draw the line sometime, Perry.
I make myself as accessible as I possibly can be.
Yes,
so I'm happy to answer questions. And everybody's situation is unique, and sometimes that's why it's so helpful to maybe talk to borrowers maybe 6 months in advance to make sure that we can get everything set up for success and for speed when the time comes.
Yes. Okay, well, thank you so much for sharing those details, and I'm sure people will pour into your inbox as quickly as this video is posted. So thank you so much, and you have a good rest of your day.
Thank you for the time.
All right, bye-bye.
Bye.